The U.S. financial system faces a shocking terror. I'm Steve Van Metre. Rates are surging, the dollar is skyrocketing, the financial system is collapsing, and that's exactly what will happen if Japan unleashes their unthinkable threat. It'll be total chaos. But the real question is, are they bluffing? Let's pick today's story up with a headline as Japan's finance minister threatened liquidation of U.S. Treasuries, sparking shock and confusion. And this is the big threat that we've been waiting for. Many people thought China would dump Treasuries as soon as the trade war started, but they didn't. We found out that the decline in bond prices and the rise in long-term yields had everything to do with the basis trade blowing up for hedge funds. But now Japan, perhaps in a situation where they're getting desperate, has now come out with the ultimate threat, one that could collapse the entire U.S. financial system, and that is to dump Treasuries. But the question is, will they do it? While addressing the question on a Tokyo TV program on Friday, Japan Finmin Kato said the country's $1.1 trillion in Treasury holdings, the highest of any foreign creditor, could be a negotiation card in its trade talks with Washington, but whether or not we will use that card is a different decision. And this, again, is the biggest bargaining chip that any country that holds U.S. Treasuries could play. And that is, if you don't give me a deal that I want, I'm just going to dump your debt onto the market. It's going to cause rates to skyrocket, and it's going to create all-out havoc on your financial system, one that could collapse the entire thing. But what he's indicating is that Japan is threatening to sell some or all of its $1.1 trillion in bonds if the tariffs are imposed, and that could be a dangerous problem for the Trump administration. Because if Japan were to start dumping Treasuries, sure, it will send yields surging for a few days. It will even send the dollar skyrocketing. And yes, it will cause a lot of chaos in the U.S. financial system, one that could bring it to the brink of its knees. But then the Fed and the Treasury will step in and buy all the excess supply, but not before Trump orders a global dollar funding squeeze, which would be a margin call on counterparts such as Japan, one which will require Tokyo to quickly spit up a few $100 billion, and Japan simply does not have, absent the Fed, wiring the cash instantly via swap lines to get the dollars it needs, just as it did for every day on months on end during COVID. And that's one of the challenges here, because when the world is naturally short of dollars, which it is, yes, you can come out there and say, look, I'm going to dump all these treasuries onto the market, but the problem is, at some point, Japan and other counterparties are going to be in desperate need of dollars, and what would happen is simply the U.S. financial system could cut them off. The Fed could say absolutely no more, and next thing you know, they're going to face an all-out crisis themselves. So this is a game of no winners, but finally we're seeing somebody put the card on the table and make the threat that, yes, we could dump your treasuries. He added that for the U.S., unstable long-term rates are a concern, and having Japan continue to hold U.S. Treasuries is beneficial. And that's the absolute fact of the situation here, because if you're an exporter, and think about this from Japan's perspective, what do you want? And we'll talk about it from an automobile perspective. They want U.S. consumers to buy their cars. Now, are consumers going to buy cars if interest rates are high or low? Well, history suggests they buy a lot more cars when interest rates are low, and so it's beneficial for countries like Japan, who benefit from exporting the United States, to buy treasuries with their excess dollars and continue to push interest rates down. If they did something that caused them to spike, well, yes, it would likely send the U.S. economy right into recession, potentially breaking our financial system, and then Japan would collapse right alongside us. And it's important to maintain financial soundness and the dollar status as a reserve currency, because those are both important issues that would have positive effects in the medium to long term. In translation, chaos in the U.S. would be painful, but it would be outright catastrophic for Japan, particularly if we cut them off from their access to dollars. It would be a nightmare scenario for them. So what we see is this as a potential bluff now, because they're in a dangerous position with a trade war. Maybe it's not going the way they want, and they don't want to make the concessions, so you come out and you say the unspeakable, that yes, we could dump your treasuries. Probably a very poor move, but I want to know what you think. Is Japan in a bad situation, or is this a negotiating card they're willing to play? Weigh in the comments below. What do you think happens if they do? And when we take a look at new privately owned housing units started in blue against a 30-year fixed mortgage rate, which we could assume would skyrocket if Japan started dumping treasuries, Well, we can go back to the 1980s and find out what happens when rates rise and we're already facing large inventory overhangs. Well, what that means is housing unit starts go down. We see that happening going into the global financial crisis. Rates are on the rise, housing starts are plunging, and that means lots of Americans are starting to hit the unemployment line. And here we can see as housing starts are going down and continuing to fall, what happens is Americans start to lose their job, and next thing you know, the unemployment rate heads higher. We see it happen during the dot-com bubble, once again during the global financial crisis, and we're facing the same scenario because builders are optimistic, but the problem is buyers are not optimistic. They don't want to buy in this market. They're worried about the economy. They're worried about their finances, and they think rates are already too high. So you imagine what would happen if rates went even higher than they are now. It would literally ice over the U.S. housing market and cause the unemployment rate to surge higher. But something else that should be surging higher, that's your trading account. We put this trade out to our Momentum Timer Pro subscribers back on April 14th. We told them to buy GBTC or Bitcoin Trust. You can see right here on the open, and that trade has taken off. It's now up over 13% and it's closed over a 6-month volume profile, indicating to us that that trade is likely going higher and putting even more money in their pockets. Here's the best part. You can join us on our next big trade. Grab the links in the description below. Use a coupon code for your free 30-day free trial, and stay tuned to the end of the show for more information. Because what it means is when the trade negotiations start, they have some cards, but this is one you really don't want to play. It tells us they're very desperate. Japan is clearly disappointed that as such a strong ally, they've been treated this way. Of course, it'll be far more disappointed if it starts dumping treasuries, perhaps the same reason we did not see China dump any more treasuries than they were already normally selling on a monthly basis, because everybody realizes if you start dumping U.S. debt, well, bad things will happen, and it's going to be inflicted on their end, and that's a huge risk. And you can just see this as frustration from Japan's side. They need a deal. They're desperate, and to me, this is the biggest indicator that they need something done and quick, because right now their economy is slowing down the entire world's economy, but one bright spot at the moment is the U.S. economy. As U.S. payroll gain of 177,000 shows uncertainty yet to dent hiring, but one of the challenges here, we know the non-farm payroll report is very lagged and not that accurate, and this is a big problem because right now what we're seeing on the headline is everybody believes now that the U.S. economy is a source of strength. As you're about to see, it may not be as strong as the headline numbers suggest. This is a good jobs report all around. The R word that the labor market is demonstrating in this report is resilience, certainly not recession. For now, we should curb our enthusiasm going forward given the backdrop of trade policies that will likely drag on the economy. And yet, what have we seen from some of the regional Fed surveys? What did we hear from ADP? Is that demand for workers is starting to wane. We're seeing layoffs pick up a little bit. We're seeing hours worked now go on the decline, and we're even seeing, of course, raises. There's people are still getting them, but they're shrinking in size, and this is a problem because all of those are indicators we're headed right into a recession. But the challenge here again is non-farm payrolls are very lagged, and here's the evidence as we take a look back at some history going back all the way to the 1970s, and what we can see is the non-farm payroll report didn't go negative until the recession was almost over. How about the 73-74 recession? Well, non-farm payrolls stayed in the plus, that is, until the recession again was almost over. Same with the 81 recession. By the time we get to the following recession in the early 80s, finally we see the government gets it closer to right as we see non-farm payrolls contract early in the recession. But by 91, they're off again. 2000, they're right in the middle of the recession. We finally see payrolls go negative. Same thing happening during the global financial crisis, and that is the issue we're facing because policies are made right around this report. So when you see 177,000, what does it tell us? That yes, our economy is strong and robust and the labor market is resilient and the employers want to keep people on the books. The problem is a lot of the soft survey data is starting to tell us the exact opposite is happening. Payroll gains were broad-based, led by an advance in healthcare. Transportation and warehousing employment rose by the most since December. Of course, we can see that reversing. And how do we know that's coming? Because here in May, what's going to see, at least in Port of Los Angeles, is a massive plunge in incoming ships. There's going to be a lot of jobs lost, probably not immediately, but you're going to see hours work get slashed. And this was on the back of a surge in imports, and activity boosted demand for labor as business rushed to get ahead of tariffs. But again, we know this is going to get reversed. This month, we're going to see some early evidence of that. And if the trade war doesn't end, well, it's going to get even worse. Manufacturing, meanwhile, shed jobs as the sector saw the steepest contraction in output last month since 2020. And why is this happening? Because, again, everybody was front-running the tariffs. At the same time, we're seeing consumers unable to keep up with inflation. Their demand is dropping. Spending is going down. This is what we heard from Harley Davidson, and it makes sense. If their sales go down and they're not moving inventory, they don't need to produce things. So at the factory level, you start to see layoffs building. And when we take a look at what's really affecting the rank and file employee, we have to look at average weekly hours against average hourly earnings, this of production and non-supervisory employees. And what have we seen after the tariff threat is hours worked have gone up. So rather than hire people en masse, what employers have simply done is they've given their workers more hours. At the same time, they've given them pay raises, but as you can see, those pay raises are shrinking. And what that means is total incomes, when we multiply the two together, are now growing at a slower pace, looking to reverse. And again, we go back to these regional Fed surveys, and what are they telling us very clearly? Hours worked are coming down. Demand isn't there. Productivity is falling. We're seeing outright production declining. And all this is going to lead is to shrinking paychecks for a lot of workers at a time. We know inflation is likely to head higher. And again, with all the uncertainty that everyone's facing, particularly with their finances and the labor market, we know spending is going to drop. And that means this payroll report, well, it's going to be an outlier, because what we're going to face in the months to come could be a recession with a positive payroll report. And economists are largely expect layoffs to pick up in the coming months as economic uncertainty puts a halt on expansion plans. UPS expects to cut 20,000 jobs as it anticipates weaker demand for online shopping. Meanwhile, Volvo and Cleveland Cliffs are also moving to shed positions, and they're just some of the companies that we're going to be hearing more and more from over the next couple months, that if this trade war doesn't end, we're going to see increasing layoffs. I want to know from you, is this a concern where you work? Are you facing layoffs either for yourself or some of your coworkers? Weigh in the comments below. Love to hear from you. Because taking a page from the Biden playbook, the March BLS report was revised dramatically lower from 228,000 to 185,000, the third consecutive downward revision of jobs numbers in a row. And this is because the BLS, when they run their non-farm payroll report, it's highly inaccurate to begin with. And so what they do is they just revise prior reports. And this is a problem because you see 177,000, it tells us the economy is resilient, that the labor market's strong. And then maybe we find out in the months to come that it's being revised down and down again. This is not a good sign. But when it comes to wages, hourly earnings rose 0.2% less than expected, and on an annual basis, wage growth also printed below estimates, rising 3.8%, the same as March, and below estimates of 3.9% last month. And what this is telling us is that workers will not be able to afford the tariffed high prices. This is something we already know. So from the Fed's perspective, they're going to be looking to see if there's a wage price spiral. Wages are rising, and people can afford higher prices, pushing them up even more. And what this is telling us is what we already know, is that workers cannot afford higher prices. But yet what you're going to hear from a lot of the experts, they're going to look at this chart and they're going to tell you, we don't understand what's going on. And they don't, because the consumer price index in red has been trending down, but we expect that to surge higher due to the tariffs. At the same time, total income for production and non-supervisory employees is on the way up. But this doesn't make sense at all when we go back to what McDonald's was saying. They said foot traffic was down. And we hear this from Chipotle and other companies. In fact, we even now heard from Wendys today. So something about this data doesn't make sense, that just because consumer price growth is decelerating and total incomes are outpacing it, well, what it's telling us is households are facing other expenses, other uncertainties, and it's a big problem. But perhaps the biggest problem with the payroll report is the birth-death model, which accounted for 393,000 jobs. Because in the face of uncertainty, a lot of new businesses were started. Perhaps as people lost their job, they decided to become self-employed. And this was the biggest number since 2023. The 5 months prior averaged about 10,000. And this should be disturbing to you, because the number is derived from estimations now placed an outsized role in this report, making everybody believe that the U.S. economy is strong. And so when we think about this from the perspective of the trade war, a strong payroll report tells the current administration to keep going because your economy is strong. But if all these jobs in this report are made up, Well, that tells us our economy isn't anywhere near as strong as the number printed. And that means no Fed cuts. Remember, bad payrolls lead to bad policy. And here you see the evidence as now experts are saying the Fed won't cut until September, despite rising risks. We already know in May we're going to get the Fed meeting next week that they're unlikely to cut because they only do what the market tells us. Yet recently, Bissett said, hey, 2-year yields are falling. That means the Fed needs to cut. And he's absolutely right about that. But when you put the payroll report into perspective, that means, again, no cut likely coming in May. For the June report, that odds are going to drop, and now we're going to push this out even further. But as I mentioned earlier, even Wendys is facing issues now as they add to the restaurant woes on challenging U.S. market. Global-wide system sales are set to decline as much as 2%, while the company had forecast in March an increase as large as 3%. And this cut follows a steeper than expected sales drop for established restaurants in the first quarter, mostly due to weakness in the U.S. due to a slide in visits. The U.S. faced, quote, challenging consumer environment. And this is notable because it's steeper than expected declines. Everybody thought the U.S. economy was strong and robust. The NonFarm Payroll report is telling us the R for resilience. And what we hear from companies like Wendys and McDonald's, R is starting to look like recession. But I want to know from you, is R resilience or is it recession? Weigh in the comments below, because if you think the trade war is going to end anytime soon, well, we got some headlines today from China that got the markets excited, but it may not be what you think. And China quietly exempts about a quarter of U.S. imports from tariffs. The move echoes steps taken by the Trump administration to exempt smartphones and other electronics from its own reciprocal tariffs, including the 145% levies on China. And the notion that China's exemptions largely mirror the U.S. one suggests this is more of a strategic move to match Washington's actions rather than purely a goodwill gesture. Now, what did we see in the markets today? That this is a goodwill gesture and that China's desperate and they need to make a deal because their economy's falling apart, and the market got really excited about that. But I don't think that's exactly what's happening here. China's likely trying to mitigate damage to its economy by avoiding a collapse in key imports. The exemption shouldn't be interpreted as a signal to the U.S., but China's been quiet about its exemptions, working through business channels and avoiding public statements. And now we start to understand China's motive, and it's the same as we see here in the U.S. You put big tariff walls up, and then you find out that there's certain big businesses that really need certain things, and if you don't give it to them, that they're going to face an all-out collapse. So you've got to make some exemptions. Is that this isn't a sign of goodwill by China. It's a sign that they want to keep their economy afloat. They want to keep this going on. So we started out with Japan threatening to dump treasuries, because what we're seeing here from not only China, but also Japan and other countries, is this trade war is nowhere close to ending. And if we keep printing strong U.S. payrolls, well, it's only going to help continue the fight. But if that number starts to turn negative and quickly, as we might see continued claims and initial claims surge higher in the weeks to come, well, watch this trade war come to a very quick end. Because once the job market goes and the global economy slumps into a recession that could spin all out into a financial crisis, you can better believe the trade war is going to come to an end, and fast. But that doesn't mean you can't profit on a decline in the economy. You can see our subscribers to our Momentum Timer Pro report are making big money right now on GBTC. We told them to buy on the open back on the 14th. They're up 13.63%, and that trade is up higher right now as we're filming. Now, what do we do? Each and every day we look at the technical indicators because we want to see when they're coming off oversold conditions. But one of the problems is when you see a downward trend and something comes off of oversold conditions, it means you could still see price fall. So what we do is we pair those indicators with the trend line. We call that Momentum Timer Pro. And what we do is we look at momentum on a 1 day, 1 month, 3 month, and 6 month window across the broad equity, bond, currency, and commodity markets, and we find some amazing trades. We get the report out to our subscribers every day, and then in the notes below, we tell you exactly which trades we think you should take and why. And every day you get the daily report. You get all of the signals, but you get my opinion on what I think are the best trades. We give you risk control levels, a full tracking of all of our open trades and returns, a weekly update, and here's the most important part, a 30-day free trial. That's right, we want your first 30 days to be on me. And why do we do that? Because we're so confident that you can make money trading our report. We don't want you to put out a dime for your first month. Grab the links in the description below. Use a coupon code for your free 30-day trial. With that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.